basic primer into the understanding of hedge funds, how we differentiate the hedge funds from the typical mutual funds, and what are the various strategies associated with the hedge fund managers, and on what lines you look at the risk associated with the hedge funds. A very brief introduction to this space. As we all understand, compared to the traditional mutual funds or any other securities, the hedge funds are less regulated, right? Whereas the mutual funds have the regulators in place, there is a lot of reporting requirements associated with the mutual funds. Whereas in case of hedge funds, because of the less regulatory thing, the transparency is pretty limited in a hedge fund. So they lack transparency. Even the investment strategies which they are getting into, they become more and more proprietary. And generally these are not for the regular public, because the number of members in a typical hedge fund cannot cross, let's say, 500. So, and that too, the hedge funds play very heavily on the arbitrage profits. The most common trading strategy for them being the long short base. So they take long positions and short positions and try to exploit the mispricings in the securities and try to get the arbitrage profit out of them. So to achieve those kind of strategies, they get into very highly levered kind of positions. They use all these mechanisms, especially let's say when we talk about mutual funds, they are restricted from getting into short selling processes, they are restricted from using derivatives. So there are a lot of restrictions as far as the mutual fund investments are concerned, whereas with respect to hedge funds, we don't see any of those restrictions. And the performance based fee is